Interest prices rise by 1%, property prices fall by 10%. This is a statement I've been hearing all over the place for the last few years. But is it true or false? What do you guys think? I've tried to do some research on this statement to see where it came from, but I can't find any real sources from it. It just seems to be a statement made commonly on social media, but there doesn't seem to be any critical data that backs it up, particularly from a housing point of view. In the last few weeks, there has been multiple of articles or reports on RTE, the Irish Times, that housing prices are going to fall because interest rates are rising. And I've been thinking about doing a video on this topic for some time. So how do interest rates impact housing prices? I do remember back in my college days, maybe 20 years ago, reading about some correlation between interest rates and property prices, but they were mainly to do with commercial property and not so much about the housing market. But it got me thinking about this myth on interest rates rising by 1% and house prices falling by 10%. And was this wrongly taken perhaps from a study that was more linked to commercial real estate? With commercial real estate, it is easy to see how interest rates do impact prices as investors look for the best return all the time when they are buying, and they also have other options in terms of what assets they can invest in, and they don't have to live in these assets. So if interest rates do rise by 1%, say, they will look for their investment yields to increase by 1% as well. They may not always get it, but they will look for it. If commercial investment yields go from 4% to 5% on an office block, that's a 20% reduction in value. Similarly, if they go from 6% to 7% in a retail property, that's approximately about a 15% value. So maybe the myth that house prices increase by 10% was somehow wrongly picked up from a commercial real estate study. I have read a very interesting report on the US housing market between 1992 and 2022. So 30 years of data on how interest rate changes correlate with house prices rising and falling. It is something I will share the details of that report or the findings of that report later in this video. It is really interesting. It surprised me. It wasn't what I was expecting. So make sure you do watch and keep watching the video, and while you're at it, like and subscribe to the channel. But let's just first chat about the common belief, which is rising interest rates will cause housing prices to fall. And the reason behind this belief is that if interest rates increase, the cost of borrowing money also increases, i.e. the cost of buying a house goes up, and therefore demand for housing will decrease and therefore prices will fall. While this theory may sound very logical, the relationship between interest rates and housing prices is actually more complicated than that. The fact is, there are several reasons why raising interest rates do not necessarily mean falling housing prices. Firstly, it's important to understand the relationship between interest rates and housing prices is not one-on-one. It doesn't correlate one-on-one. And there are many other factors that affect the demand for housing and therefore the price of housing, including income growth, employment, savings, population growth, changes in consumer behaviour, changes in government policy and incentives as well. Interest rates are just one of the many factors that affect the housing market. Their impact on housing prices might actually be more limited than once thought. Secondly, rising interest rates tend to point to a strong economy or high inflation, which pushes prices up, which can increase the demand for housing as people tend to want to buy sooner rather than later because the value of their real money is weakening. A growing economy can also increase its number of employees, increasing demand on rental units, inflating the cost of renting. And while borrowing costs might be going up, it still could be more affordable to buy rather than rent. Thirdly, rising interest rates can lead to higher lending standards, which may limit the supply of new housing. Developers may find it harder to get funding, which will reduce the supply of new housing coming onto the market. This is already kind of happening in Ireland. Also, you have current owners may be slow to sell if they have favourable interest rates at the moment on their current home, and this will reduce the supply of second-hand homes coming onto the market. So if new supply and second-hand homes are limited, this will also drive up prices. With international markets, rising interest rates can affect currency, which in turn can impact or affect the demand on housing from foreign buyers. Some locations may become more affordable for international buyers. Ireland has become more affordable for US buyers than it was 2 years ago. It's also worth noting that the relationship between interest rate and housing prices may vary depending on the local housing market. Some cities and regions rising interest rates might have a greater impact on the housing market than others. For example, areas that have a high proportion of first-time buyers who are highly sensitive to changes in interest rates, the rising interest rates may have a much bigger impact on housing prices compared to a city that has a lot of high net worth individuals or high wealthy buyers. They will be less sensitive to changes in interest rates and will have a less of an impact on the housing prices. So if you think about that from an Irish point of view, where nearly 70% of all households in Ireland are mortgage free, rising interest rates are not going to really impact the owner of those houses in the vast majority of cases. And it's going to impact more the first-time buyers or the people who are on variable rates. But a huge percentage or a huge proportion of the housing market is mortgage-free, and raising interest rates is not going to impact them. I do recall going to a conference last year in New York, and a question was put to a panel of developers about how interest rates are impacting sales. And the answer was quite clear. At the high end, if people were buying or paying more than $2 million for an apartment, they weren't that overly worried about rising interest rates. But if they were buying a home at about $300,000 and it was a large percentage of their outgoings, it was having a much bigger impact. So let's get back to the theory that if interest rates rise, housing prices will fall. As I said, I did read a really interesting study on the housing market for the last 30 years. It was a US report, but the findings were actually quite surprising to me. It was a study on the US housing market from 1992 to 2022. And it looked at every single month for 30 years and how interest rate changes impacted housing prices. What you would expect to see is when interest rates declined, house prices would go up, and when interest rates rised, house prices would come down. That's what I was kind of expecting to see a little bit. Well, when mortgage interest rates declined, house prices increased 193 times out of the 360 months during those 30-year period, which is kind of what you might expect. When mortgage rates increased, house prices increased a whopping 117 times, which is way more than what I was expecting. When mortgage interest rates declined, housing prices also decreased 49 months. So when rates fell, housing prices also fell 49 months out of the 360 months. So the big question is, how many months did prices decrease when mortgage rates increased? House prices only decreased a total of 6 months in the entire 30 years when interest rates were increased. So house prices were more likely to increase when interest rates increased than decreased. And house prices actually fell far more often when interest rates were decreased rather than increased. Overall, the study found that mortgage interest rates and house prices have a very weak correlation of 0.26. The study also reviewed if there was any lag on the interest rate changes and reviewed price changes 2 years after the effective interest rate change. It was found that there was no considerable change due to the lag effect, and the correlation was even less at minus 0.15. In other words, mortgage interest rates and housing prices tend to move in opposite directions. Granted, this is a US study and every market is different, but the information is telling. The study did find that when there was consecutive rate rises, house prices growth did slow, but rarely went into the negative. The study also suggested that rising interest rates and price reductions in housing were more linked to major economic crashes like the 2008 crash, or at times of really high unemployment or great uncertainty. And rising interest rates were more linked to an overheated economy, and rising interest rates did slow growth and did slow double-digit growth, but growth was still there and retained within the housing market, as generally speaking employment was still high and overall the economy was still growing. When interest rates were reduced, they were reduced to stimulate a weak economy when house prices were already falling. In summary, it cannot always be assumed that rising interest rates will lead to a fall in house prices, and it's an urban myth that rising interest rates by 1% will force house prices to fall by 10%. But it's more complex than that. Interest rates are just one factor that affect the property market and can't be looked at in isolation. Other economic factors must also be considered. Rising interest rates will have an impact on the commercial market and the commercial investors, are going to factor that into their return of investment, which will lead to perhaps lower commercial prices, which maybe lead to less investment in businesses, which may lead to a drop in employment, which may lead to a drop in confidence, which will ultimately maybe lead to a drop in prices. But it's not guaranteed that there will be a drop in prices because of a drop or because of an increase in interest rates. Anecdotally, I have been speaking to commercial lenders and investors, and it is getting harder and harder to source funds, and therefore there likely is going to be a drop off in development in the near future, which will weaken supply even further. Let me know what your thoughts are on it by dropping some comments below. Show your support for the channel by liking this video, also subscribe, and as always, thanks for watching.